On today's show, 3 questions. Number 1, is the economy on track? Number 2, what's the update on China? And number 3, are we headed for a tax cliff? Let's go. Welcome to Dentist Money's 2 cents, where we help dentists navigate all the noise. I'm Matt.
And I'm Rabih.
Yeah, you are.
Hello.
It's just us two today, Rabih. It's just us. It's just a
Do you know what this
cozy-
means? It's going to get as nerdy as it gets.
There's literally no one to stop us from getting nerdy. And when I say we, I mean you, and then I'm just here for it. But we're just like 2 little bugs in a rug, just snuggling up, talking economy, markets, taxes. Like, it's going to get wild. It's going to get wild.
Yeah.
Buckle up. No, so we couldn't normally, as everyone knows that listens to this, all of our dedicated listeners know that it's usually 3 of us. Just time of year was tough to get someone else in here, so we just thought we'd hop on, just Rabih and I. Excited to be here. Rabih, let's jump right in. Number 1 is the economy on track.
Yes.
I know you got a lot for us, which is probably good, it's only 2 of us.
Yeah, honestly, so because we've been recording on other days, previous weeks, we missed out on like the reports that come out every single week. I'm talking about the initial claims for unemployment, the unemployment rate. I'm talking about other readings for CPI. So I was like, let me summarize them because I'd like to share this stuff. So
Yeah.
let's start with the least important of all, inflation. It feels weird saying that, but least important for them all, inflation. Back on October 10th, we got the CPI reading for September, and it was on track. So for August, CPI was at 2.5% annualized, and for September, CPI annualized at 2.4%. So the drop has been gradual. The drop is in line with expectations, although some forecasts were saying maybe it should drop to 2.3. But between 2.3, 2.4, 2.5 at this point, when the Fed has already started cutting interest rates, isn't really of a concern. And this is just kind of, I would say, the first point on the side of, yes, we are on track. Inflation is acting the way it's supposed to. It is under control. So that was for the headline CPI. For the core, which is usually a little bit higher because food and shelter have been going, food and energy have been going down a bit. Core CPI is at 3.3, similar to previous months. So inflation has been going flat, but it's going flat at a really low level, which is very close to where they want it. And again, those are CPI, not PCE. So we would expect them to be far away from the 2% target. And with that, the market really didn't react to it or care. There are so many other stuff that the market is reacting to right now, which we're going to get to, but inflation is not on that list anymore.
Hey, Rabih, we've done this before, but I think it bears repeating as we get new people listening, or just a good reminder. Can you give like a really quick 30-second breakdown again of difference between CPI and PCE and why each matter?
Both of them are a basket of goods that people are going out there and they use it to reflect what usually people buy. So it's going to include portions of food, your expenses regarding energy, whether it was transportation or heating or usage at home. It'll include a portion for shelter and the other services like healthcare and other basic needs, etc. The main difference between a CPI basket and a PCE basket, and CPI stands for Consumer Price Index and PCE calls for Personal Expenditure Index, is that in the PCE, it accounts for the ability of the consumer to substitute products within that basket in a way that makes economic sense. So if there in the CPI, there is only, chicken and beef in that basket, a PCE might switch them out and maybe include fish when, for example, beef goes and becomes so expensive. So it accounts for a rational behavior we have of just trying to go and find a cheaper alternative if it's getting out of budget. And that's the difference between the two.
You're saying PCE will have the exchanges based on human behavior, CPI does not.
Exactly, 100%.
Got it.
And the Federal Reserve actually follows PCE and it tracks it more than...
Because it seems more realistic that people are making decisions based on prices, changing out, like you said, meats or finding alternatives. So we tend to believe that PCE is probably more of an accurate reflection of actual real world growth based on decisions being made by individual citizens.
Yes.
Got it.
100%.
Perfect.
Yeah.
Love it. Thanks for going through that.
Yeah.
Go ahead.
It also, me being nerdy, so it also prevents an outlier effect. Like we were talking about the port thing a couple of weeks ago, and we said, "Oh, banana."
We solved
prices.
the port thing. When you mean when we solved it?
Yeah, we solved the port
Man,
thing.
all in a day's work, just solving the port strikes. No big deal.
And we said banana prices might go up really high. So if bananas were a portion of the CPI and they like went exponentially high, now a banana costs you $50, you will see a CPI reading that's really high, and you'd think the economy is really overheating. But in reality, we're just gonna switch it out to mangoes, right?
Yeah.
So it allows it prevents it from being hacked, the CPI as an indicator, and that's the benefit of it.
So sorry, just really quick, since we're going down this road, we're getting nerdy. So that logically would tell me CPI is always higher than PCE, basically. Like, is there ever a situation where it's not?
Well, if the prices, mainly food and energy, because those are the most volatile, if those really drop really quickly,
then I guess you could see it flip
before they start reflecting it in the PCE. Because for example, chicken might become very, very cheap, but you like to eat meat more than you like chicken. You're not going to do the switch as fast as what a CPI would reflect.
Got it. So you might have blips. You might.
It's not that CPI is going to be always higher or always lower, but CPI is going to fluctuate much faster than PCE would fluctuate.
Got it. Makes sense. Okay, thanks for going through that. I think it's hopefully a good reminder for people.
I love it. The next thing is initial claims, and the definition of those, is an initial claim is a claim filed by an unemployed individual after a separation from an employer. The claim requests a determination of basic eligibility for the unemployment insurance program. Those data points are issued every single week. Every single week, people are getting unemployed, and they are going to file for unemployment. And the number of people are reflected. And it's a weekly indicator for unemployment, which is good. You don't have to wait a month over month. And for the past couple of months, actually, I would say from 2023, this has been fluctuating within a band. It's not being, so the upper limit has been 260. We hit it in like 260K in a week. So in 1 week, 260,000 American workers got laid off and applied for unemployment. And in June 2023, it hit like the 260, and the low was maybe in September 2022 when it was 187K. So that's the range from 187 at the lower bound to 260K on the upper now.
Pretty tight range overall.
Pretty tight range. And the reason it's pretty tight range, because like when COVID hit, the initial claims, I had this data handy. So the initial claims on September 4th, 2020 for that week were 6 million people. So just to give you it's it's a very tight range, and it's moving very slow compared to when like a crash happens or something important happens.
Yeah.
And the latest readings have been for July 2024, it's 250K, August 228, the first week of August, second week of August 233, third week of August 232, and the last reading we got is 241. So so it is closer to this 260 than it is to the 180s. It's closer to the upper bound than the lower bound, but it's still within this very narrow bandwidth that we've been seeing for the last year and a half. So it's tight. It is closer to the upper level, but it's still within the normal range that we could expect due to cyclicality, due to the fact that the weather is changing or holiday season might be coming up, etc., etc. So another checkbox checked.
Yes, another box checked.
Another checkbox. Yeah, I can't say it. I'm sorry.
So we've got inflation looking good, jobless claims looking good.
Jobless claims looking good, and jobless claim is the more of the volatile indicator of unemployment. So let's jump to the more slow lagging indicator of unemployment, which is the unemployment rate. Also data for that one came up, and let me give you, so we were stuck at beginning of the year, like January, we're at 3.7, and it started increasing gradually from like 3.7, 3.9, 4, And then in July, we hit the highest it was at 4.3%. And the Federal Reserve, as you remember, came in and said in their summary of economic projections, we're going to reset the clock. That was in September. And now we think unemployment rate is going to be 4.4 for the rest of the year. Like it will end the year at 4.4.
They're like, yeah, that sounds good. 4.4. Let's go with that.
4.4. Historically, it's still low because on average, like the average of the US historically over last 70 years, the average unemployment rate is around 6%. So
wow.
Although it's an increase from 3.5 to 4 or 4.4, it's still not 6. We're still low. The economy is doing really well. Let me give you the readings that we received since that July number of 4.3. In August, it dropped to 4.2. In September, it dropped to 4.1. And we are now at 4.1. So we retracted back. It seems like the economy is expanding back up again, mainly due to expectations, but also mainly due to, back to school season, the August, September. And now we're heading up to the holidays. So there is going to be a cyclicality. And because we're tracking it based off a 0.1 percentage points, it can be noisy, but it's definitely clear that 4.1% is lower than 4.3%. And there is some easement in the labor market. This validates the fact that, unemployment is not going to get out of track and maybe a soft landing is possible. And now maybe in December, the Federal Reserve will come to us and say, oh, oops, sorry, my bad. It's actually going to stay 4% for the year. That shouldn't make a difference.
They're just going to be like, we're going to go back to 4, and then it'll bounce up again in Q1 of 2020. Never mind. They're just going to follow whatever the number is.
I wouldn't be surprised.
Yeah.
But as long as they can have this degree of freedom, what would be scary if they suddenly, in their expectations, say it's going to drop back to 2 or like 3 or go up to like 7? Like those swings that we are talking about just tells you that the economy is cruising. We're doing really well.
Yep.
And unemployment is in check. Inflation is in check. And that's actually reflected by the all-time highs that we've been seeing. For the last week and a half, all 3 major indices, the Dow, the Nasdaq, and the S&P 500, have been hitting all-time highs, albeit, is that the word?
Albeit
on different days. So really strong indicators, and even some, bank analysts are setting expectations for the S&P 500 to end the year at 6,000 level, where we're right now at the 5,800. I can't forgive myself for saying that word incorrectly, but I need to move on.
You're like, I am so thrown off right now.
Yes. So another box checked, Matt. We've got the the sensitive indicator of unemployment in check. We've got the lagging indicator of unemployment in check, and we've got inflation in check. And the market is reacting positively. However, although we have the S&P 500 at an all-time high, the VIX is at its highest percentile for the last 6 months. And what I mean is, I'm not saying that the VIX or volatility is high. Volatility is actually in the normal range. But compared to the last 6 months or 26 weeks, it's in the highest percentile. This is the highest in the last 6 months by very small deviations. And this is usually odd. You do not expect the S&P, you do not expect the market to break all-time highs, but at the same time, volatility to be itching higher. They have a very, very strong negative correlation. But I think this could be easily explained to the fact that we have elections in 2.5 weeks.
I was just going to say, it's got to be elections.
It's got to be elections. And we know, and we've covered this on the podcast before, that volatility tends to spike around that time. And to add to that, earnings season's just started. And I have some data for you regarding the earnings season.
Yeah, you do.
Are you ready?
Ready.
Okay. So it's still in its start. So we're not going to really focus on it as much because those data are going to be changing really quickly. But so far, 71 out of the 500 companies in the S&P 500 have reported earnings. The year-to-date expectations for growth are 4%. If you exclude the energy sector, it's around 6.5, which is still healthy, but lower than we see. Out of these 71 companies, 83% of them reported above analyst expectations. This compares to a long-term average of 66.9%, but also higher than the last 4 quarters, around 75%. So 83 versus 75. So
Got it.
Above analyst expectations. So we're still beating. It's the momentum of earnings is still going. Maybe this has been showing by how Nvidia is breaking a new all-time high. But 71 out of 500 is still not even 20% of the companies. And most of the companies that reported, I would say 27 of them were in the financial sector. So, and this is a sector bias. We have to wait until tech. We have to wait until, consumer discretionary, etc.
Still a good sign, though. Good sign.
Still a good sign. Netflix just reported yesterday night, and it's up
great, right?
It's up 11% because it beats really strongly. So we're gonna be looking at this, and hopefully, I'm really hoping, like fingers crossed, that earnings come in good and they kind of remove a little bit of the noise from the elections. So we'll see how it goes, but we'll see. Blended revenue growth is estimated at 4% as well, kind of similar to earnings. If the energy sector is excluded, 5%. So on the top line and bottom line, we're seeing growth, and they are in line. And a 4% growth in the top line and a 4% growth in the bottom line, it means that margins aren't getting hit, and that's also a good sign. So we'll look at that going forward. But it seems like, yes, the economy is in check, and it is on track. What the Federal Reserve is communicating is being reflected. Because of that, ease of mind, the market is reaching to an all-time high, and earnings are there to support it. There might be volatility for the next couple of weeks, but this does not mean that we're good. Like, the U.S. is really good.
So we've got inflation, check. PCE, CPI, looking good. We've got unemployment, both, like you said, lagging and leading indicators in the sector, employment section of the economy looking good. We've got earnings looking good. We've got the markets at all-time highs. We've checked every box, it feels like.
It's looking really good for the American economy right now. There's always going to be concerns, and there's always going to be narratives. But if we look at the data, it seems like we're in a very healthy economy, and we do not see any cracks preventing it from continuing to do so, economically speaking.
So obviously the connection here, Rabih, as always now, the new kind of like, it was inflation forever, right? And then unemployment for a little bit. Now it's, what's the Fed going to do with rates? Where are rates at? Are we still seeing basically a foregone conclusion of rates continuing to come down based on the market predictions?
Market expectations haven't changed for rates, and we can hit them in more details next week if you want, but they are still expecting on November 7th, 2 days after election, they're going to cut by 25 basis points and another 25 basis points in December. And in 2025, they expect for the whole year 1% cut. So I don't know how it's going to be distributed.
Probably another either 3 or 4.
Yes, we don't know how it's going to be distributed. The latest data actually validates that and doesn't make you come up with a different conclusion on a different path. This is one of the very few weeks in the market where the market and the Fed are aligned in their opinions, right? So until a new data point comes in or an event happening, we would expect this, it's slow, steady, in the right direction, and boring, and this is what we like.
Got it. Yeah, we do love this. I love slow, steady, and boring.
Yeah.
Defines my life. Awesome. Okay, so I think we hit that got Rabih. I think we get the economy. The answer is it is on track. We kind of went into all the details there. We'll tease a little bit more around Fed or the rate cuts, but we feel there's no other reason to believe right now that they're not going to stay on track with market expectations of cuts coming November, December. Number 2, we wanted to hit, Rabih, the update on China. We talked about this last show, maybe 2 weeks ago. Maybe give an update of what's happening with China.
Yeah, although not a lot happened, and this is not going to be a very long segment, but I feel I teased it so much that there's this going to be big press conference after the market rallied up 34% and then crashed 10% in one day to, tell you what happened. So they did the press conference. Let me give you some details on it. Uh, uh, China has something called a white list, which is a list that real estate developers, real estate companies can be on. And those are the lists that the government approves to give them loans. Because currently the problem in China, you've got a lot of houses that are empty but unaffordable and people can't buy them. Their solution is to create even more houses to make them affordable. They're trying to flood the market with houses, although they have a lot already. And their real estate developers have been struggling since end of COVID due to slower economic activity, and they have a lot of houses that are still in development. Like they built half of it. They can't back out of the project because that would bankrupt their real estate developers, but they also can't continue because the economic situation doesn't allow for it. So the government was like, we're gonna, on top of those stimuli that we talked about, that they're gonna pump money into the stock market, etc. They're gonna be providing a line of credit for these real estate companies. So what they ended up doing, they increased the amount. So a total of 2.23 trillion yuans have already been approved in loans to whitelisted developers. That figure will almost double to 4 trillion yuans by the end of 2024. So that has been kind of the main thing out of that press conference. It was like, oh, you guys think that just us providing liquidity is not going to solve it, so we're going to also provide credit on top of the liquidity, in the hopes that this credit that we're providing, the banks are going to take it and the banks are going to provide it for those real estate developers. Real estate developers will finish these projects, make houses affordable again, and make China great again. I don't know what's going to happen, but we really don't know what's happened, just because the consumer confidence in China has taken a really big hit, given the stock market struggle and the fact that they've all been flocking to gold. So this might be a very gradual progress to the economy. I've got some quotes from this CNBC article that I think helps clarify the picture as well. They're like, is it a disappointing briefing? We're just fine-tuning existing policies. There isn't really new policy. The volatility in the Chinese stock market is likely to continue as investors, quote, lack conviction that the stimulus package and what's been announced is going to turn things around. So it's a lot of money. It's around 6% of China's
monopoly
GDP.
Money.
But just because it is not targeted, it's not through a policy that propagates through the economy, but more as just throwing money in the air, trying to solve the solutions. They do not think it's going to solve the issue. On Monday, after the press conference on Saturday, the stock market advanced by 5%. So it's recovered 5%. And so far, I'm looking at data since July. I'm looking at the performance of the iShares Trust China ETF. Since July, I'll consider July levels where it was flat. It appreciated all the way up to like 34%, and then crashed down and then increased by 5%. So since that July number, the market kind of after the storm settled to be 18% above the previous flatness. So that money did elevate the stock market. It elevated it by like 20%, but they do not expect it to have an impact. And the fact that the problem is economic, it's not financial in China, it's going to take time. So while the stock market might react really quickly, they're going to probably readjust as they see the economy gradually drifting towards the new equilibrium that the Chinese authorities are trying to work towards.
Yeah, I'm so glad you just said that, Rabih. It's such a good reminder of we've talked about this, like the disjointment between the stock market as a reflection of, a lot of times a reflection of expectations in the future of where things are going with their country or business or whatever, whereas then the actual economy. It sounds like everything going on with China that you're describing over the last time we talked about it and then now is like structural issues they're trying to solve. That's a massive ship, and they're not going to turn that thing overnight. It's going to take a long time.
It's not going to take one press conference and
exactly.
a bunch of money.
Yeah. Even though the market's going to react to a press conference and they're going to predict the future, and that's what prices are oftentimes going to reflect. It sounds like this is going to be a long journey of them trying to, specifically around real estate, it sounds like, restructure and mend some issues there to maybe get some consumer confidence back.
100%. And
So,
again, for those who didn't listen to last week's podcast,
shame on you.
See?
Look at us.
Although China is going through its ups and downs, it's not going to matter to a globally diversified portfolio, as we've mentioned. Emerging markets ex-China, according to last week's data, were up 6%. Even with China doing, all the circusy stuff, it's only 5% for the index. So the impact is really limited, and you're still healthy in your emerging market exposure for the year. And we're going to talk about this on the Client Huddle today. And in a globally diversified portfolio, you're still doing really, really well when this is combined with US and developed markets.
Perfect. Love it, Rabih. That was a lot. Hopefully it's helpful. We're nerding out. So we're going to finish. We've talked a lot of economies. We've talked China, specifically in real estate, global diversification, the importance of that. Now we're going to finish up with the wonderful topic of taxes. We are literally blowing up people's weekends. I don't know how it gets better than this after these topics. But we wanted to, as we, I think, all know at this point, I would imagine.
I don't know why you're being sarcastic. This actually makes my weekend.
For us, hopefully some people out there, you're like, this actually is. So as you alluded to earlier, and I think everyone at this point knows, big election coming up with, I think, some pretty significant, ripple effects depending on who wins, depending on the area of the economy, or obviously whoever you're cheering for. We are not going to get political with this, but I do think it is important to talk about probably one of the biggest things, kind of the remnants that was left of the Trump era, or his first run in office as president, was his tax cuts. So the Tax Cuts and Jobs Act, that was in 2017. Some of you may or may not know that those were temporary. So at least at the personal level, I think some of the corporate things were permanent, but at the tax or the personal level, they were temporary. And so they are set to expire. Several of the individual tax kind of changes and provisions they had in there are set to expire, what they call sunset, at the end of 2025, so the end of next year. So I thought it was a good opportunity. I think this could be a whole like separate show or webinar we could maybe jump into. Maybe we bring on like a CPA and we can like kind of break this down either kind of near the end of this year or beginning of next year. But we wanted to at least get it on
Once
your radar.
Once we know who wins, right?
Well, honestly, this is going to have a big impact on this specific thing. And so just as a reminder, so Tax Jobs and was it Tax Cuts and Jobs Act of 2017. So the main kind of areas that it really focused on, the key provisions, were a few. So first of all, it lowered the federal income tax brackets, and we'll break that down. It increased the standard deduction to the point where, I don't have the number off the top of my head, Rabih, but I think it was somewhere in the ballpark of like 90% of people now take the standard deduction for ever since this act went in place, because it was so much bigger that itemizing deductions became kind of a non-issue for people. It increased and made it a more generous child tax credit, a 20% tax deduction. This is a big one for dentists, or can be a 20% deduction for pass-through businesses. And then the higher estate and gift tax exemptions, they doubled. So these are the key areas that, and we don't know, by the way, we have no clue right now. If Congress does nothing, these are the areas that will revert back to pre-2017. And so, but Congress, Senate, Senate and Congress, they have some power here to possibly extend the whole thing. They could extend certain provisions of this. We don't know. We have no idea what's going to happen. I don't think we're going to hear anything about this until after November of what's going to happen. So I guess initially, Rabih, before we jump in, I think the biggest thing would be talking about a couple of key areas, maybe the estate planning part of it, and then also like the actual tax brackets and some changes there. But I'm going to give you a chance. Any thoughts initially on any of this?
When you mentioned Congress, it's like, if I want to create probabilities whether we're going to get a Trump presidency where this gets extended or enhanced, or a Harris presidency where something new is developed, or just expired, I would give the higher probability to an expiration scenario, simply because if you have a mixed Congress or a mixed government, so it's Trump presidency, Democratic Congress, or a
Yep.
Harris presidency, a Republican Congress, most likely than not, they're just gonna bottleneck each other and nothing would happen. So the highest probability is this just expires. You would want the president to have his party or her party win the Congress for a new tax thing to come up.
Sure.
Yeah.
And I mean, that's such a good point. I mean, and we're not, I mean, we're again, not getting political and saying we're rooting for one or the other. What you're highlighting is for tax changes. This is something I don't think people really realize. For tax changes to actually be made, and specifically to increase taxes in America, is really hard. And it's because of what you're highlighting.
Yeah. You need a majority in the House of 50 plus 10 or something. Yep. And then you need a 50 plus 1 in the Senate, and then it needs to go to the president to sign it.
Yep.
So it's a lot.
So when you have this mixed, not only that, and I don't even fully understand this in regards to
total majority. Sorry, it's 60% of the House.
Oh, there you go. Total, yeah, there's the simple majority, then total majority.
Yes.
But there's things here as well that I don't even fully grasp of, like, you know, how they can, even if they had those majorities, let's say, things that the minority party can do to filibuster, to stop, like, it gets so complicated to get things, and especially to get things controversially like taxes, anything with tax changes actually put in place, increasing taxes. I think you're probably right. I would imagine the betting favorite would be favoring simply an expiration, because to get anything put in place would be really difficult. So neither here nor there. We have no clue. We're not sitting here saying we know it's going to happen. I do think it's important to understand, if it were to expire, what does that mean? So let's hit first a reminder, and I think this is also a good reminder as we're going through this, to remind something, probably one of the most misunderstood parts of taxes, being the difference between an effective tax rate and a marginal tax rate. Mm-hmm. I think this is just a good reminder for this. So, so right now, 2017 through 2024, one of the biggest changes made from the Tax Cuts and Jobs Act was a reduction in marginal rates across the board. So the current tax brackets, and I guess this is where I'll kind of hit this. We in America have what's called a progressive tax system. So the way I describe this is you're filling up buckets. So as you make money, you're filling up every tax bracket is a bucket, and until you fill that bucket, you are not going to the next tax bracket. And once that bucket is full, so I'll give you this example. So currently, the tax brackets, the lowest tax bracket as of now is 10%. So your first, if you're married filing jointly, your first $23,000 in income is filling up that 10% bucket. Once that is full, you're jumping to the next bucket. From 23,201 up to 94,000, you're jumping to the 12% tax bucket. But each bucket is taxed separately. Progressive tax system. That is where we talk about marginal rates being the buckets, and then your effective rate is the combined tax average across all your buckets. Mm-hmm. So I wanted to just highlight that. So as of now, 10%, 12%, 22%, 24%, 32%, 35%, and the highest marginal rate is 37%.
So
this
you
is
could
for
have
filing
money
jointly.
Yeah, so you could have money funneling into the 34% bucket, but your effective tax rate, because it's an average across all of them, is still at 26 or 27.
Exactly right. Okay. Exactly right. We see this all the time where dentists will say, "Oh my gosh, I'm taxed at 37% plus my state tax. Like, I'm giving half my money to the government." In some cases, you are. Like, if you're in California and you make enough money, you probably are giving half. Your effective tax rate truly is. I've seen as high as truly 50% or somewhere close. Wow. But for most people, when they say, "I'm in the highest tax bracket," sometimes I hear this egregious, kind of like approach of saying, like, "I need to just make less money." And it's like, okay, sure, that is a way to make less taxes, but all of your money when you get to the highest tax bracket is not taxed at 37%. It's just the dollars that go above that bucket, or that have filled the previous bucket. Any dollars above that are taxed at 37%. So to your point, Rabih, yes, like your effective rate is never as high as your marginal rate. It's always lower. So you might be in that 37%, but yeah, your effective, we see all the time. It's like, oh, your effective rate is actually 27%. You have to take the total amount of money, fill up those buckets, take the average, and then figure out your effective. So again, 10, 12, 22, 24, 32, 35, 37, those are the brackets right now. What this would revert to if this expires is back to pre-2017 numbers. So that would be 10% still for the lowest. And then every single bucket is now increased. Every marginal rate is now increased if this sunsets. So it would go 10%. Next bucket would be 15%, then 25, 28%, 33%, 35%, and then 39.6. So every single marginal rate is increasing. So go ahead.
The second bucket is increasing from 12 to 15. The third one is increasing from...
Yep, great. Let's do that. So 10% stays the same. Second bucket goes from 12% to 15%. I know this is a lot of numbers. The third bucket goes from 22% to 25%, and then 24% to 28%, 32% to 33%, 35 stays the same, and then the top bucket goes from 37 to 39.6.
Interesting.
So pretty much across the board, outside of a couple of these marginal rates, taxes are going up for the individual, pretty much across the board if this gets put in place. So I think hopefully that's helpful just to at least understand. Again, Rabih, you've got some numbers here of what this could look like from a projection standpoint of like at a global level, at a macro level. But if these expire, I think pretty much everyone could expect that both marginal and effective tax rates would most likely go up.
Yes.
So we're not going to get into this all today. There are some planning things to be considering. Certainly, hopefully you have an advisor you're talking to be bringing this up. I'd be bringing this up now of just things to be considering. However, I will say this tends to lead to sometimes behavior of like overthinking things. So there's only so much you can do. Yes, you want to be thoughtful about this. You want to be careful. You want to be strategic. But this is where, when this stuff happens, salesmen come out of the woodwork to start pitching you crap that you don't need, pretending like this is some life-changing situation. It's not. Like, yes, there are things to optimize, but let's not overhaul everything because you might pay another 1 or 2% in taxes.
Yeah, there's this saying, I love it. Don't let the tax tail wag the dog, right?
Yeah, and the investment dog. Yeah, exactly. And we get it. Believe me, I don't love paying taxes either. None of us do. And yes, there are things to be doing strategically, but again, just as a reminder, don't be overhauling everything because again, your effective tax rate might jump a couple percent. I will say one thing: just something as a simple thing. If you are at the highest tax bracket, you will be saving that much more money by using things like a properly structured retirement plan. Right? You are now saving another. If you're the highest tax bracket, you're saving another 2.5 to 3% of your money every dollar you put in. So that just makes those types of things, or let's say like an HSA, it's going to make those things even more effective for you.
Or using municipal bonds from the investment
exactly.
side.
There you go.
There are a lot of tools at your disposal.
Yep. So those 3 examples right there are things that, yes, you should be talking to your advisor about. You should be thinking about. Just don't let the tax tail wag your kind of investment strategy dog by saying, now I have to overhaul everything. Really quick, last thing on this. And again, like I said, we should probably just do a really deep dive into these things for a separate show or webinar. I think another one to just highlight really quickly, because of the significance of this, would be the estate planning adjustments. So there's what's called a lifetime estate and gift tax exemption. So as of right now, it is 13 points. So basically what this is saying you are exempt, your estate is exempt from paying estate or gift taxes up to a certain amount of money. And this is the threshold for that. So as of right now, it's 13.61 million as an individual and 27.22 million for married couples. So what does that mean in practicality? Let's say you died, RIP, we love you, God bless. let's say you died, you're an individual, you have $13.61 million exactly in a taxable estate when you die. Today, in 2024, none of that estate is taxable for estate taxes. And then again, if you're a couple, 27.22. That is set to revert and be cut in half if this sunsets. So now as a couple, it goes from 27.22 million down to 13.61 million. Why is this a big deal? Because this can be, your estate could be subject to tax up to 40%. So if you are in the situation where all of a sudden let's say you're at a $20 million taxable estate right now, well, and you're like as a couple and you're well within that threshold of 2024, well, all of a sudden in 2026, when this reverts, if it does, you are now in a taxable estate situation by like $7 million. So this is where planning needs to be done if you are in this range or you think there's a possibility of getting to this level where you want to start being thoughtful from an estate planning perspective. Rabih, what say ye? Any thoughts?
No, I like it, and we've been having the conversation about what this means to the American citizens' pockets, right? This means more money is getting taken out of the Americans, but this money is now going to the government. A higher tax, or reverting back to the older tax regime, means more tax revenue going to the government, and we know that the government, out of any consumer in this country, they are the worst because they are in debt. They accumulate deficit every single year. So there are actually numbers and projections on how reverting back to the old tax system or extending the Tax Cut and Jobs Act would impact the deficit and the debt that the government faces. And they're not too much of data, but I'd like to share them. So we kind of measure, so the government takes on debt but also pays interest on that debt because they're a bad borrower, as we mentioned. And in that sense, what percentage of the interest that you pay is, or what percentage of the deficit that you go into each year as a government is going into paying interest? And as of currently, the government, out of every single year the government goes into a deficit, around 7% of that is to finance and service debt that they have taken on previously. So if we do not extend the TCJA Act, that would kind of stay around 7%. But if we end up extending the TCJA Act, which means less government revenue, less revenue coming from taxes, that would increase up to around 8.5%. So extending it, while it's good for the American pocket, actually digs a bigger hole to the government in terms of their revenue. This is all assuming that the government stays spending at the same rate they are spending. And in terms of the debt, so we're talking about the interest that is paid part of the deficit. But if we look at the whole debt, like how much is our debt as a percentage of GDP, right now in 2024, it's 97.7, which is close to what it was high, the level it was during the Second World War, which was the highest. It was around like 110, 112%. If we do not extend the TCJA Act, we are, according to forecasts, of course, by 2034, so 10 years from now, we're going to go from 100 or 97% debt to GDP level to 120% debt to GDP level. But if we end up extending the act and having the government receive less tax revenue, we would expect the debt to the GDP level to go from 97% all the way to 131%. So an extra 11% of GDP in debt because the government is missing out on that tax revenue. But this is only one side of the equation. Again, this is the government receiving less money. You can also solve it by the government spending less money. And here's where it gets political or policy takes control. But what we objectively know is that higher debt and high percentage of interest servicing out of your deficit each year actually prevents the government from putting money where it matters. So, the creditworthiness of the U.S. on the long term, 100+ year, is in question.
Got it. And yeah, this is the part where people are yelling in their car about policy and why this or that. We're highlighting, to your point, Rabih, there's multiple sides of this, and we are just giving the data. But it makes sense just in theory. Like if this gets extended, the consumer pretty much across the board keeps more money by paying less taxes. But to your point, that can hinder the government. There's other ways that the government could solve that possibly. Again, this is where it gets into policy and government spending and all that kind of stuff. So we just wanted to highlight that this is looming, that if nothing is done, there is this tax, what people are calling kind of this tax cliff, and this reversion to pre-2017, or I guess 2017, policies. So we want to be aware of that. Again, the call to action here, just be talk to your advisor, be aware of it, be thinking about things that you could be doing strategically without overhauling everything, because it's not going to be some massive, it's not required to do that. So, okay, Rabih, we've talked economy, we've talked update on China, we've talked taxes, anything you else, we still yap for a while, just you and I just yapping away. Any other thoughts,
that's
Rabih?
fine. We covered monetary policy, we covered fiscal policy, we covered markets. I'm going to sleep well tonight.
Yeah, you are giddy. Your weekend is set. Yeah. Everyone, thank you as always. Thanks for listening, Rabih. Always for imparting your wisdom and knowledge on us. As always, if you want to talk to us, we love talking to dentists. We love hearing your story. We would love to answer any questions you have about your specific situation, point you in the right direction. Go to dentistadvisors.com, click on the yellow book free consultation button. Also, it is coming up time, Rabih. I'm getting reminders from the team to be bringing up our summit, our second annual summit, the Dentist Money Summit. Our first year was incredible. We have no reason to believe. We have all of our speakers lined up for 2025. We are so excited. June 20th and 21st of 2025 in Park City, Utah. That can also be found at dentistadvisors.com for any information there. As always, thank you so much for listening. That was our 2 cents. Till next time, have a good weekend. Bye-bye.